Welcome to the Armchair Trader podcast. Thanks for joining us today. It is the 6th of October, and today we're talking to Steve Ward of Performance Edge Consulting, who is a coach to traders and fund managers, and a man who can provide traders with a little bit more insight into the psychology of trading and perhaps avoiding some of the common pitfalls that are out there. Welcome to the show, Steve.
Thank you, Stuart. Thanks for the invite to be here.
I've done a little bit of research already on what you're offering traders and investors, and it does actually sound really, really interesting to me. You hear a lot about from educators of traders and people who advise traders about the technical aspects of trading financial markets, but you hear less about the human aspects as well, and the psychological aspects. And it's a very intriguing approach that you have here. Could you just tell our listeners a little bit more about your own background and what it is that you've been doing?
Sure. I mean, I think first of all, you're right. I think there's an emphasis on trading on the technical and sort of the strategy side, the process. And I think about performance, and this is true for trading performance, as being probably three parts, which is craft, mind, and body. So the craft is really the trading skill, the trading knowledge, the strategies, the process, a lot of the doing. And then that's the core part. But when you're doing what you're doing, that's being influenced by what's going on, obviously, in the mind and also in the body. So there's a psychology and a physiology piece that's playing out around that process. And that's the piece that maybe is given the least focus. It's increased a lot over the last few years, but obviously that is my domain, is sort of the mind and body to enhance the craft. So so my background basically was sports performance coaching, sports psychology in essence, helping athletes and teams in, I think it was about 33 different sports all over the globe, developing sort of the mindsets or ways of thinking and then the mental skills to apply in sort of the competitive environment to improve their performance. And again, obviously they were doing work on their fitness and obviously on physio and massage and so on, and recovery. That's on the body side. Obviously they're doing the technical tactical work with the coaches, and then obviously I was there doing my work on the mindset side of things. And then the transition from there into trading was purely by chance. It was a chance encounter with a meeting with someone who attended a sports psychology program I was running, and they also happened to be the head of performance and learning for a large proprietary trading group. They had 5 offices globally and about 250 plus traders. And it was really just a chance conversation with the question, do you think this might work with financial traders? And I was honest. I said, I don't know. I don't know much about that world. So I went down to London. We met. We met some of the traders, had some discussions, and anyway, from that it led into me spending about a year there. Ended up 3 days a week providing coaching and training. Essentially, in those days, this is 2005, early 2005. Utilizing primarily sports psychology to enhance trading performance. And then really over the last 15 years, my expertise or my tool set has expanded massively, because obviously there are differences between athletes and traders. So really chance encounter. I did the Winter Olympics in 2006, and really beyond that, 95% of my work from then and to now has been with sort of the trading and investing space.
When you were working with professional athletes, were you tending to work with people who were individual performers, or was it more team? And I'm thinking here because in an institution like an investment bank, you'll have a lot of traders working together as part of a team and with somebody providing overall direction and risk management.
Yeah.
Whereas with what I would call non-professional traders, so it could be somebody who's just sitting at home all day and trading the market. That sounds to me more like someone like a professional tennis player, for example, who is on their own. There is no team of other people working with them.
Yeah. So when I was in sports psychology, I probably spent 70%, 75% of my time with individuals and probably 25% within teams. I actually had a big interest, and this is my own personal interest as well as my sort of psychology interest in sport, with extreme adventure and action sports type athletes who tend to be individuals and obviously risk takers and so on. So that was my sort of special niche within the field. But also did a lot of team sports as well. What I say about teams, trading teams as such, especially in banks, is there's a lot of trading teams that are called teams by name, but they're not teams by, let's call it, function, i.e., they're essentially a set of individuals who are working as a collective under the umbrella of the equities team or the commodities team, whatever you want to frame it. So it's only been probably more recently that there's been a greater focus on actual teamwork in terms of collaboration and working together to generate P&L. Certainly historically, I say, it wasn't really trading when I was from '05 to probably 15, 16, 17 wasn't really a team activity. And I think probably investment firms are probably more collaboration and team focused than perhaps banks are. And of course, as you said, most hedge funds, you turn up, you get into your seat, and obviously then you make the money you can make, which is probably more akin, and same probably for prop trading as well, where I think hedge fund trading and prop trading and probably the private traders are probably more akin in terms of, it's your screens, your strategy, and also you go and you try and make the money that you can. So there's not a lot of obviously access to flowing information and clients and so on. So yeah, so predominantly my work is largely with individuals.
What's kind of the difference? Obviously, sports people spend a lot more time running around and maybe in better physical shape than traders. But beyond that, are there any special any big differences you found with traders versus professional athletes in terms of what you're called upon to advise them on? Are there differences in their thinking?
Well, there's two main differences that come to mind immediately. One is the fact that obviously most sports are primarily physical, and obviously trading is cognitive. So it's a mental activity. So I think that is the big difference. I mean, both can be competitive, both can have stress and pressure, both have a craft that you're trying to master, both require commitment, determination to kind of, to succeed over time. Both have to deal with winning and losing, obviously, so that's a big factor. But the other key factor that I think is different between trading and sport is how often you might have to deal with winning and losing. So if you're a sports team and let's say it's football, keep it simple, and you're playing twice a week, you have two events where you win and or lose and you have to recover from. Some of my traders are making 10, 20, 30, 40, 50 plus trades per day. So, they can be dealing with winning and losing and the emotions attached to that on a much more regular basis. So I think that's one difference. And also the other key factor is in trading, there is no off season. So in sport, there's obviously a competitive season and those obviously have been extended over the years, but there is primarily an in season and there's an off season. And even during the in season, there is a lot of built-in recovery and, downtime and training and practice. And for most people in the trading space, there's you're trading. Well, you've got the weekends free, but you don't, the 5 days, maybe even into the weekends, you're doing your trading and your research and prep, and you can be doing that 52 weeks a year. So and that has challenges. And again, obviously just the exposure to the ups and downs, I think, can be heavily magnified in trading. But of course, it does depend on your trading timeframes. And if you're doing day trading, it's going to be very different if you're doing obviously swing trading versus longer time frame trading or investing. So there are ways that kind of obviously does mitigate with time frame, but generally I think there's more exposure to those stresses and demands in trading than perhaps there is in sport.
Do you think that that's a common problem with a lot of traders in that they're not budgeting that downtime for themselves, and that can then feed into compounding stress levels and or potentially contributing to mistakes, and that some of these losing streaks that some people complain about are actually just could be down to simple fatigue?
Yeah, for sure. And actually, I have undertaken quite extensive physiological assessments with traders. So we've hooked them up to monitors which measure their stress levels, measure their sleep patterns, recovery patterns, physical activity patterns. So they give us an indication of how much strain they're under on a moment-to-moment basis and over time. And then we've looked at that against market volatility and kind of market trading intensity. So we can see the impact on the markets on their bodies, and then we see the impact of their bodies on their decision making. And it's definitely true that as traders become fatigued, it does impact their decision making. as a general rule, as fatigue increases, we tend to become more risk averse. People are obviously more prone to making errors as they fatigue. The brain's looking for kind of quick, easy ways. So we're more prone to bias when we're fatigued. So traders do not trade at their best when they're fatigued. And depending on obviously the context you're in, so obviously for private traders, it's different to bank traders, different to hedge fund traders. But essentially, most of us are exposed to stresses and fatigue in some way, because even a private trader who's maybe working full time and then perhaps is doing their trading in the evening or trying to fit it in during the day, you've got work fatigue, you've got the fatigue of life in general, maybe if you've got a family and so on, and then you've got your trading on top. If you're trading in a bank or a fund, you've also got the stress and pressure that the trading is the work as such, and that can create fatigue. Lots of traders work pretty long, hard hours, quite intense, a lot of pressure to perform. So, but I think there is, certainly the research that I did, which we did for about 2 or 3 years, shows that there is definitely a high level of fatigue that occurs in traders. And that's obviously in the body. This is the mind-body piece. So the fatigue is occurring in the body, but the brain, which is about 2% of our body weight and uses about 20 to 25% of our energy consumption, requires fueling. And of course, the fuel is coming from the body. So as the body fatigues, it affects also the ability of the brain to perform. So it's why in my work, I always say, the craft is one, but we must always look at the mind and body together, because the body does play a big role in risk-taking and decision-making. And there's a great book called The Hour Between Dog and Wolf by John Coates, which talks a lot about the biology and how traders' hormones shift and change based on whether you're winning and losing and the impact of fatigue. So yeah, there's lots of good evidence to show that the body is playing a big part in how we trade.
I spent 2 happy years working in an investment bank, and I was certainly aware of that. As you become more fatigued, you make mistakes. But are there any other common errors or mistakes that you find a lot of private traders are making? Just the key ones that just keep coming up again and again, and that people need to be aware of.
Yeah, I think the common ones will be the ones that that people will be familiar with in their own trading and investing, that we would read about in most books. So things, the basic ones really around holding on to winning trades long enough is a challenge for people. On the other side, obviously, some people are not as quick or easy to take their losses as they might want to be. Hesitating to get into trades can be a challenge for some people. Likewise, just pulling the trigger in general is difficult. Then you've got, sometimes people are perhaps trading positions that are too big for them, which creates fear and anxiety and stress, or maybe they're trading sometimes too small for them, so they're not maximizing opportunity. Then you can get bored and complacent. So position sizing, I think, is a key factor. Fatigue and tiredness we've talked about, but I think that is definitely a common factor. Being attached to positions, so getting too attached to the trade or married to the trade, as we might call it, that definitely plays out for people. Then I think there are people who trade out of boredom, which I think is a big challenge. So that's probably the opposite of that is being patient. Yeah, I think a lot of people engage in these trading behaviors because thoughts show up or emotions arise that they don't know really how to manage them, so they're acting on them. And I think one of the commonalities in trading is that we're often being exposed to emotions and thoughts and sensations that can be a bit uncomfortable. And as part of our preference as humans for comfort, we find ways to avoid that discomfort, but unfortunately, it often leads to behavior which also is comfortable but reduces our returns. So I think there's probably 10 or 12 very common ones, not just for private traders, interestingly, but also in experienced traders. So these play out as part of the human condition and the challenges of taking a risk under conditions of uncertainty. And then it's really about they happen, and then it's really having the skills and abilities to be able to. You can't get rid of them, but I think you can reduce them, and you can reduce the frequency, and you can reduce the magnitude, so you can reduce the impact of them on your returns.
That's really interesting. I mean, I've done a lot of interviews with hedge fund managers. I must have interviewed over 300 hedge fund managers, and the issue that has come up sometimes is this one of, I need to be in the market, i.e., I've got too much cash. My investors are putting pressure on me, and they have an expectation that this strategy should be active. And although there might be a lack of opportunity there in the market, and your rational brain is telling you, no, there's nothing interesting, they will go into a position which is unsuitable just because they feel better
Yeah.
that they're giving, that they're delivering exposure somehow, and that seems to
Yeah.
be quite a common occurrence.
Well, that's what we call that bias to action. And it's a strange one because we perceive the action as being the right thing to be doing, and that's where the pressure comes from the investors. It feels like you should be being active, i.e., kind of in a sense you should be earning your money. But in a way, it's a bit like saying, well, if policemen aren't out and about handcuffing people, they're not doing their job. Or if firefighters aren't out putting out fires all the time, they're not doing their job. So it doesn't. And same, if you look in the military, special forces, you haven't got to be firing your weapons to be doing your job. And I think it works on both sides from the investor perspective and from the hedge fund manager perspective. It's the awareness of what's the purpose of what we're trying to achieve, which obviously is maximizing market returns. Then it's into process. What's the most effective way for us to do that? And that will mean recognizing periods where we should be invested and periods where we maybe shouldn't be invested, and allow kind of building the process and then trusting the process to achieve the outcome over time. The challenge we all have, and this is true for all traders and investors and fund managers, is we get too attached to the outcome. So we get too worried to we get too focused on the outcome, and it takes our attention away, and it causes us to deviate behaviorally away from the process as we get greater attachment to the outcome we're trying to aim for. If the outcome is better than expected, we can deviate as we get overconfident. If the outcome is not as good as expected, we can feel the pressure now to deviate away, take more risk maybe to try and get back on track. And I think this shifting, or one of the core things I teach in my process, is we need to really become curious about how we make decisions and make almost the core part. Well, for me, the core skill in trading is making decisions under conditions of uncertainty. So what we should be looking to do as traders and fund managers is improve the skill, which is the process, which is the ability to make good decisions under conditions of uncertainty. And the more people spend time and effort investing in getting good at that craft as such, the better the outcomes will become over time. But if you focus just on the outcomes, it doesn't always lead to you taking action to get better at the craft as such. So it's a bit of a paradox, but it's the same thing in sport, and I did some work with poker players, and it's the same in poker. You've got to play the hand that is the best hand to play. And then, in poker, you lose a lot of hands. The variance is high. In trading, you will lose some trades. It will be a good decision, but you'll lose. Likewise, you can make a bad decision and win. So where there's probabilistic environments, it's really the main focus on the process and over time on improving that process.
No, that sounds very sensible, and you're absolutely right. We do see that, and we've seen that recently with traders and investors who become very attached to a particular company. You see it more with the small caps guys, but
Yep.
I've seen it with we're seeing it at the moment with a lot of investors are sitting in stocks. I'm not going to name any names, but these stocks have been losing money pretty much since the start of the year, certainly since the start of the pandemic, and you can see that they are emotionally attached to these companies, even though all the rational data is saying you just got to cut that loss and leave it, because because some of these ones are now beginning to look very, very rocky and may even be out of business by the end of the year. But the investors are diligently defending that company in public and arguing its case, even though the bad news is stacking up every single week. And you see it with fund managers as well. I mean, there's been some very interesting decisions made by some fairly high profile asset managers in the last 12 months to back specific companies or sectors. And you have to ask yourself, why on earth have you done that? I would have thought all the evidence was against it. But I guess that underpins what you're saying about this emotional attachment to a specific piece of the market that is more about the person than about the actual asset they're investing in.
Yeah, well, I think attachment in general is and attachment generally creates rigidity. So if we're really strongly attached to a view, if we believe the market's going up, and I really believe that, and I become rigid to that, then I lose the flexibility of doing something different or reversing my position or changing my mind if I'm proven incorrect because of the market dynamics. And obviously, if you've invested a lot of time, maybe researching a stock, and you spend hours and hours and time and energies invested into it, and then you've been in it for a long time. It's like a relationship. If you invest lots of time and energy into a relationship, it can be quite hard to break up. And that's what it can be like, when you're in the market sometimes. If you're in a trade for a long time, you put effort and time into kind of generating the idea. You've done all the sizing, you've entered the position, now you're in it. And each kind of day that ticks along that you're in it, essentially you're in that relationship for a little bit longer. And like in life relationships, there's kind of ups and downs, and you kind of weather the storm on the up and the down. And, the emotions come and go, and you literally become attached. Then you become rigid. And I think one of the skills, the high level mental skills in trading and investing, is flexibility. Not just at the behavioral level, but also how we can maybe be flexible with the thoughts that arise and the stories we have about who we are as a manager, a fund manager, and as a trader, and about the emotions that show up and how we work with them. And certainly in my framework, it's very largely built around a sense of flexibility, not randomness or kind of just in the flow type, doing anything that we think, but allowing some maneuver, because we have to appreciate, obviously, the markets are dynamic and the world is dynamic. And what we think about now and our views right now may be correct now, but they may not be correct for some people even later on today, if not tomorrow, next week, next month, next year. So just having that flexibility. And I just finished doing some coaching with a hedge fund manager recently. And one of his big takeouts from the coaching was the idea of being a bit more flexible and recognizing, for example, shifts in market dynamics, and keep updating. What's the context of the market now? So we don't get sucked into almost assuming that it's going to be the same today as it was yesterday, because things can be very different today. But we need to kind of keep that updating of the context as we go along. And what does that mean in terms of the positions I've got on, the decisions I might make and the risk I might take and allocate and so on.
That's very interesting, because it is something that you do see. For example, the changing context of the markets has caused some big names in the hedge fund space to actually say, you know what, this isn't the same market I made all my money trading. It has fundamentally changed.
Yep.
A lot of my core systems are not going to make money anymore. And these guys, admittedly, have made enough cash that they've actually said, I'm taking a step back. I'm not going to manage money for third parties anymore. I'm just going to be running as a de facto family office. And
Yep.
I've seen several cases of this, of funds I know in the last sort of 12 to 18 months, where they've recognized that change. I guess if you're a private trader, you just have to be a little bit more aware that the market, even 5 years ago, that market is different. Well, I mean, there will be some asset classes or some markets that haven't really changed that much, but a lot of them, the dynamics have changed. There are different participants. There's different ways of doing things. Technology has changed things. Patterns are changing, and I guess it's important that you're aware of that, and that you adapt to that.
Yeah, well, certainly if you want to sustain performance over time, then you'll need to be able to maybe have some flexibility in the short term, and then for definite, you'll need to be adaptable in the longer term, because it's just, in pure evolutionary terms, there will be changing shifts. And I mean, I've probably seen, since I started working in trading in February 2005, and I kind of got launched into a bit of a shift in terms of the sort of the pit trading onto the early days of electronic trading. That was a big transition then. And there's probably been, at least 3 or 5 pretty significant shifts since then. And the reality is that some traders, adapt and stay in the markets, and other ones maybe sit out and wait it out a little bit, and other traders keep going but don't adapt, and and in the end, either through fatigue or frustration or through financial situation, have to exit the market. So definitely when we work with, sometimes with the newer traders, I continually stress, as a core skill to develop, this idea of flexibility, and doing research, thinking into the future, how might the market be later this year? What might be some key themes, or what might be some themes that play out next year? And what does that mean for me and my approach? And are there any skills that maybe are worthwhile working on, or, knowledge to gain that could be useful for me? So I'm preparing myself for the future. Much as when I was working in sports psychology, if we had an athlete now training for the Olympics in 2024, you've got to be thinking about, what will it take to win in 2024. You can't train to be the winner this year. You've got to be thinking about, what do we, how might the world of sport be in 2024? what's the environment going to be like, what roles technology going to play, what training methods might we be able to access, so you can grow somebody into being a medal winner in 2024. And that's some of the work I've done with some of my clients, both individuals and also organizations, is trying to get a sense of, where the market trends are going, how the world of the markets might be, and, the sort of the role of technology in trading and investing and so on in the future. And what does it mean in terms of who you need to grow into so you can be not only successful now, but also in the future. Otherwise, you're behind the curve all the time.
And one of the things that I like about, I mean, I know you've written a couple of books as well, and you obviously have your course, but you are focusing more on the individual, because obviously, everybody's different. We see a lot of trading courses where people promise a specific system, and it's a certain approach to trading that is meant to work for everybody and potentially every market, whereas in fact, I know for a fact that different markets have different characteristics.
Yep.
Emerging markets currencies are different from, say, trading cable,
Yep.
but also the individual trader. Everybody is slightly different in the way they think and the way they behave, and it sounds to me like what you're saying is you've got to be a little bit more self-aware and about yourself and the way you think, and your risk tolerance as well, in order to be more successful.
Yeah, well, I always think about, if you imagine like an equilateral triangle, and if we go to kind of each of the apexes, you'd have the trader I normally put at the top, and I put market bottom left and strategy bottom right. So, and then for me, what you're trying to do essentially is you want to try and find the best match possible of the trader's kind of strengths and styles, and obviously skills, knowledge, and ability, and so on. And you want to try and match that with a strategy, a way of trading that is aligned with, particularly around things like their risk tolerance and their tolerance for uncertainty and volatility and so on, which will then lead them into, obviously, certain markets will be more or less volatile and so on. And actually, it's a bit like, again, if we kind of go into the sports world, it's like each of us will have different physical strengths and characteristics. And then also you're trying to match into perhaps the sport. So it might be athletics, but of course, athletics has everything from, a 100-meter sprint, or even 60 meters if you go indoors, right up to the marathon in running alone. Or you might not even be a runner, you might be a thrower. So even if you find athletics, you've still got a lot of work to do to try and get into the event. And trading is very similar. And that's why I like it, because it allows people the ability to experiment and find their own style and find the markets and find the strategies. And again, it's like relationships. You can randomly stumble into, love at first sight with the first, partner you meet, and then you stay together for 50 years or more. Or, as is often the case, we have to try, a few different partners out, and then we find out, what we like, what we don't like, and then we build that relationship. And it's very similar with the markets. You've got to do the experimenting and trying. And this is the downside sometimes, as you were saying, of the courses which are sold as this is the way, is they'll be being sold by a person who is, let's assume they are successful, and what they're selling is their way, and it works for them, and maybe you can verify it, and that's all good. It just doesn't mean that way will work for all people. But the reality is everyone needs to start somewhere. So you need to start with a course, but I think the path from kind of beginner through to being kind of competent and expert in trading is trying out lots of different approaches to begin with, then getting a sense as to the one that maybe feels right to kind of spend a bit more time on, and then you can start to go, okay, this is still quite standardized, and then the goal is to individualize it so it works for you in terms of your lifestyle, your living conditions, your own context, how much you've got to invest, and then your personal strengths and styles as well.
That's a very important point you make there, because everyone's lifestyle is quite different, and certainly as far as traders are concerned, there are some people who may only want to just put on one trade a week, versus someone who's in the market every day, sitting in front of their screens 12 hours a day. That's a very different demand from someone who's I'm going to have only one or two trades running at a time, and there will be days I won't be in the market at all.
And again, some of that will be determined by time availability, how much time have I got available, but also it'll be dependent upon the person's risk style, so their kind of preferences. Do I want to be somebody who's trading actively and being exposed to a high number of winners and losers each week and have to deal with that, And then do I want to do that maybe as outright positions or maybe as spreads or pairs trade to try and sort of diversify the risk a little bit? Or am I somebody who actually would rather just make, a longer time frame type of investment where there's more kind of work being done that's maybe more cognitive and kind of the planning and researching, and then it's on and I kind of just step back and let it do its thing. And what people need to essentially try and do is we've all got a preference for how much risk we like and kind of how much uncertainty we can handle and how much tolerance for kind of the consequences of these decisions we can take. And then it's just trying to find the way that allows you to express that in your own unique context. And that's generally where people will be more successful. And this is why sometimes when the courses are being sold, they perhaps don't take into account enough of the individual difference. It's like saying, I don't know, Usain Bolt saying, he's going to run a course where, you can guarantee that everyone will run the 100 meters in under 11 seconds and, make it into the national team. It's just not going to be true. Yeah. Some of those people who turn up would be great marathon runners or might be great shot putters or even better footballers and so on. So I think just having the awareness, for me, and this is part of what I love about trading, is from when you first get hooked into it and get excited about it, there's a kind of a whole long-term pathway ahead of you with lots of ups and downs. But part of that kind of path, which is, I call it kind of the route of mastery, when you're trying to master the craft, the mind and the body. But part of that is a lot of experiments and testing things out and trying things, what works, what doesn't work. And then at some point, and I've heard it called the clicking point quite often by some of my clients, things just kind of start to come together. Things make sense. You find your style, you find your way, which is great. Then we have to appreciate that sometimes the dynamics then change and you might have to find a new edge or a new way of doing things. So this is kind of the continual kind of creative stroke, flexible skills, which are really important. But yeah, I think it's really, I think the goal is to find your way of trading if you're going to be successful.
Having now I've said, there is this trading is not one size fits all. Can you tell us a little bit more about your own approach to coaching traders? What sort of courses do you offer, and are they primarily for beginners or do you have courses for more advanced traders? How does it work in practice in terms of how you go about educating traders?
So for me, Stuart, the majority of my work is institutional. So it's with banks, hedge funds, commodities trading houses, prop trading groups, energy companies, and so on. And that tends to be a mixture of probably at the more junior level in those organizations, perhaps for the grads and for newer traders, we might do a lot of group training and education type programs. As traders get more experienced and more skilled, then the value is much greater when we probably do it, from a one-to-one coaching perspective. Now, this year, really just down to the coronavirus situation, because I'm normally on the road most weeks and traveling, but I am going to be for the first time running a program, and it'll be like a training / group coaching style format for private traders. Up to this point, really, most of my work with private traders has been, speaking on podcasts, writing the books, speaking at events, all of which I enjoy. But I don't get a lot of time spare outside of my institutional work to do much formal work for private traders. So this year, I say literally, because I've been a bit more housebound, or certainly homebound, then I've managed to put a sequence of consecutive weeks together where I'm going to be at home to run a training program for the private traders, which I'm very excited about.
So this is actually a unique opportunity in many respects for private traders to benefit from the experience of someone who typically works with the pros, because of the every cloud has a silver lining. Yeah. In this case, it's your availability to the smaller trader to benefit from your experience.
Yeah, it was something that about 6 years ago, I think it was. There was a trading education company who asked me to do like a collaboration, and we did like they marketed out to their database, and I kind of ran a program. I think it's about 6 years ago, and it was very well received, and I enjoyed delivering it. And since then, I've had lots of similar requests, and I get a lot of individuals contacting me for coaching or for training, and I've not been able to do anything until this year. And I thought, this is a great opportunity now with a different set of kind of working conditions to do something. So that's what I've done. So I've put together a training program. And what I wanted to do, and you framed it very nicely, Stuart, what I wanted to be able to do was just to have the chance to share some of the insights I've had working with some of these highly skilled trading professionals from all over the globe across different asset classes, and some of the techniques that I use when I'm working with them and some of the strategies, and then to share that with sort of the private retail trading population. But not just that. I don't want to make it just me talking and telling them what I do and how I do it. I want to do this program. The goal of the program is that we're going to essentially, someone who comes on that program goes through almost like a coaching process. So there's going to be lots of reflection and assessment type exercises, so we can kind of really start to think about what it means for you as an individual. There will be some education, some training alongside that as well, but lots of exercises, lots of techniques to do. There'll be exercises to do between the sessions and kind of how you personalize it for your own trading context. And then we kind of work through, I think there's 7 sessions over about 6 weeks, which are basically like an hour of us working together. And then there's a Q&A session at the end, because I want people to be able to ask questions and to, share progress and actions as we're going through the program. And then we're going to take a pause. I think it's about 5 or 6 weeks, and then come back together for like a Q&A, share progress, actions, challenges. So I want it to be an experience where, as much as possible, we're working together. So it's not something you could just get from a recorded online course or such. I want people to be able to engage, ask questions, personalize, and just make it a very personal, immersive experience. That's the goal.
Oh, that's fantastic. So people will be able to interact with you and ask you questions and raise some of the issues that they're experiencing at the moment with their own trading.
Yeah, and also, obviously, what's good about that, and this is really important, so many times when I work with traders, and this is my institutional guys, they'll go to me, have you ever heard this from somebody else before? Because it feels like it's only them, and probably 99% of the time, I say, yes, I've heard that same thing many times. Maybe the underpinnings behind the challenge are different, but the challenge you're having is not unique. And I think just hearing other people talking about those challenges and maybe providing some insights and some ways of working with them, and people obviously sharing their own ideas, things that they've done. I haven't got all the answers. Sometimes traders are very creative and very successful with finding ways of dealing with challenges themselves. So just being part of that sort of community, and we're keeping the numbers limited, so it's not going to be hundreds of people. I'm keeping it pretty tight, so that we can, or I can allow, because it'll be me doing all the work, but so I can allow enough time and energy to take the questions, and to, people can send emails in, as we go through the course and so on. And between session 7 and the Q&A, there'll be that 6-week gap. People are going to be encouraged to have a training plan to kind of work on things, implement some of the techniques. And again, there'll still be support available for them as they go through that. So in total, I think it probably runs over about 3 months, which gives us enough time for people to kind of really take away what's useful, embed it and practice it with support. Because that's a challenge between when you read a book. Most of us have read lots of good books. They might have exercises in the book even. We might do them at the time, or we don't do them, but we don't always follow through long enough to ingrain them. And that's what I want to get in this program is the goal is that we not just learn it, but we do it. Mm-hmm. So we're ingraining it, and then you've got it, and hopefully that makes you better when you come out the other end.
And if someone's interested in joining one of these courses, obviously there's only a limited number of spaces available, so sign up as soon as you can. But how do they get in touch with you? What's the best way for them to contact you?
Best way would be obviously either through the Armchair Trader website, Stuart, because obviously you've got the link on your site there. Otherwise, through tradeatyourbest.com.
Oh, that's fantastic. Thank you very much indeed for coming on the show, Steve. That's been really illuminating, and I think that's a really refreshingly different take on some of the challenges that active traders face on a daily basis. So thank you again for the insight. That's been brilliant.
You're very welcome. And again, thanks for the invitation. Appreciate it.
Thank you for listening to the Armchair Trader podcast. Make sure you subscribe to receive further episodes as they come online. And if you want to learn more about trading and also about what's happening in the financial markets, make sure you check out www.thearmchairtrader.com.